Third video of Unit 3, Biased Reporting. Good, so now we know that regulation is a thing in financial reporting and that it is hard to come up with optimal accounting rules, but that theory can help us to have a somewhat more informed debate. Now it's time to move on and think about one of the outcomes of mandatory reporting. So when we have mandatory reporting, then of course, the question is, well, how do managers cope with these mandatory reporting rules? And one question that is very popular in the literature that people have looked at over and over again is, well, do managers manage earnings? So do they manipulate the information that they provide, and does it pay off? And this is a super broad stream in the literature, and people have their opinions, and I also have my opinions. But here I try to take a relatively neutral, fresh view at this. And so my quick and dirty answer will be, well, they do so because they're incentivized to do so, and it does not pay off. Well, obviously this is a brutal short answer, so there's a longer answer, and the longer answer is, well, it depends. Yeah, so, this depending bit is something that I also want to show you, but first I want to address all this by actually talking about three models. And like always, I will try to focus on the intuition of the models. I won't give you the math behind them, and I also only think on subsets of the models that are that are in the original papers that I talk about. But still, I think by talking about these three models, I can give you the intuition of some of the theory debate around earnings management or biased reporting. And it should motivate you maybe to pick up the original papers and to spend some time with it, because they are much richer than what I'm going to tell you here. So let's start with the first thing. I labeled this stupid incentives. So stupid incentives, of course, sounds a little bit unpolite, but the reason why I labeled these incentives as stupid is, for one reason, first of all, because they are exogenous in terms of the model. So here, this is not really a model even, but it's the idea that underlies an empirical paper that is highly influential, Healy in Journal of Accounting Economics 1985, so another classic. And this paper looks into the association between managerial compensation incentives and earnings management. And so one thing that I will talk about this also a little bit later, but one thing that is in this setup here is very important is that the bonus plan that we're looking at here is exogenous in a way that it's just been imposed on a manager. So for reasons that are outside of this model, this bonus plan exists. So this bonus plan is a very stylized bonus plan, but relatively representative for bonus plans that exist in everyday business life. So this is a bonus plan that compensates or pays out a bonus depending on the reported earnings. And there is a lower range and there is a higher range. So if your earnings fall short of the lower range, there is no bonus whatsoever. If your earnings are above the higher range, there's also no higher bonus whatsoever. And so the bonus is capped, in other words. And so in the reminder, there's some bonus, and here the bonus depends on the reported earnings. It doesn't really matter. So for what I want to tell you, even if we can do without all the little symbols here, because what I want to show you here is very straightforward. I want to look at the earnings management incentives that such a bonus plan induces with a manager that likes money and that is aware also that managing earnings now will backfire to some extent in the future. Meaning that if the manager manages earnings upwards now, at some point in the future he can manage earnings less, or he has managed to manage earnings downwards even, simply because accounting, as we know, is linked through time. So if you for example recognize revenues now, then you cannot recognize them next year. Yeah. So now what you see here in this wonderful graph is you see the starting point, true earnings on the X, reported earnings on the Y-axis. Here we have no earnings management. This is why the line here is on the 45 degrees diagonal, meaning that true earnings are reported as reported earnings. Okay, so now you see the two reddish plotted lines. These are the lower and the upper earnings management potential here given by capital KT, right? So that would be the maximal amount of earnings management that our little manager can do. So now we just have to think about, well, what will happen if we now impose this bonus plan and these incentives actually start to materialize. So let's look at the first part here, relatively simple. If earnings are very high, so if the true earnings are higher than the high earnings, then there is no point for the manager of actually reporting these high earnings, simply because the bonus is kept anyhow, so the manager doesn't get any more money. So, and if this is the case, then it becomes beneficial for the manager to just manage earnings downwards. Okay, so this is also called as cookie jar reserving. Yeah, so referred to cookie jar reserving means we're saving a little bit of earnings potential for rainy days. So we're trying to manage our earnings a little bit downwards to build up capital K. Yeah, so small k would be negative in this case. So capital K sub t plus 1 would be increasing because we save earnings potential. Okay, so now what happens if our true earnings happen to be between L and H, so in the bonus range. So in this area, obviously it makes sense to boost up earnings. Yeah, so to boost up earnings up to obviously the bonus cutoff point H. Okay, and this is what you see now in this green line. Yeah, you see that as soon as we meet the bonus threshold L, low, right, we will move the earnings upwards by the maximum amount that we can do, KT plus 1, yeah, and KT, sorry, and then we will report earnings that are aggressively inflated, right, and we will do so until we reach the bonus cutoff, and then of course we will reduce our earnings management behavior, yeah, down to 0 when true earnings are actually also at the high cutoff. Okay, so this is an area where we have aggressive earnings management again. Okay, so now the only thing that is left is what happens when our true earnings are actually below low. So here we have a little bit of an ambiguous zone even, but here for the simplicity of the argument, I assume that the manager now has an instant incentive to actually manage earnings downwards again, because first of all, yeah, so managing earnings downwards allows to save earnings potential for future periods, right? So you have the you have the negative K, and the negative K will lead to larger capital K in the future, right? So more earnings management potential in the future. So this creates an incentive to manage earnings downwards. Obviously, as long as you are just below L, you can still manage earnings upwards as well and maybe move it above L. Yeah, so to still get a little bit of a bonus. And now whether you do this or not will depend on your discount rate and of course the amount of earnings management potential that you have to invest in order to reach L. Yeah, so around this there's a little bit of a gray zone where depending on the assumptions that you make, you might still see some positive earnings management even if true earnings are below L. But yeah, here, as I said, for the sake of the argument, I said, okay, let's assume that there is a 0 discount rate, so meaning that there is no point in doing something now that you can do more efficiently in the future. Okay, and then you would simply downward manage your earnings instantly and take a big buff. So now this is very bare bones. There's no strategic interaction here whatsoever. So this is why it's not really a model. Also, the fact that the bonus plan is exogenous is interesting here, because if you see this, then you instantly would think about, well, who would draft such a bonus plan if it would be so easy to manipulate, right? So can this be an equilibrium outcome? Can the executive boards and outside board members really be so ignorant that they draft such a bonus plan which is so easy to manipulate? And of course, it's tempting to say, no, this can't be right. But at the same time, you see that bonus plans like this still exist, and you also see empirical evidence, interesting empirical evidence that shows us all these distributional kinks around the 0 distribution of earnings, which is a little bit in line with maybe the 0 line being a low threshold thing or something like this. Yeah, so there is still evidence that something as simple as this might actually be going on within firms. Yeah, so sometimes earnings management is simply hardwired by misaligned or stupid incentives. Okay, so here the compensation plan is driving a direct push for managers to actually manage earnings. So first intuition that I wanted to show you. Okay, so now let's move on to the next intuition. So the next intuition is a very seminal paper by Jeremy Stein in the Quarterly Journal of Economics, 1989. And so this paper tries to understand the interaction of myopic, short-sighted managers and a competitive, rational capital market. The basic idea of this paper can be shown in this game structure here, and it's very much linked to a prisoner's dilemma. Let me try to explain what is going on. So in the Stein model, we have managers that are rational and a capital market that is rational. We have managers that have a hardwired incentive to sell some of their assets or to raise additional capital. It doesn't really matter, it doesn't have to be that specific, but they have an incentive that hinges on the current stock price on the capital market. So they have an incentive actually to boost prices on the stock market, and the stock market is aware of this incentive. So in the Stein model, the Stein model is not an accounting paper, so in the Stein model, managers don't manage earnings by doing smart things in accounting. In the Stein model, managers manage earnings by foregoing positive present value projects and trying to boost stock prices by actually reporting positive earnings directly, other than investing, for example. Yeah, so real earnings management in the Stein model, basically. Now, what is the problem here in this setup? The problem is that the stock market builds rational expectations about the behaviors of the manager. So the stock market is informed that the managers have the potential to manage earnings, and also understands the, let's say, the incentive structure of the manager. So the stock market is aware that the manager actually has an incentive to boost stock prices. So now what we have here is this typical game setup, and I butchered the whole model into something very simple here, into a numerical example, so that you can get the basic intuition about what is going on in such a model. So now what you have here is you have the manager, and the manager has an incentive to manage earnings. So indicated here by the blue lines going from left to right, right? So regardless of whether stock prices are low or stock prices are high, the manager has always an incentive to manage earnings. Why? Because the firm is being priced based on the earnings information that the manager is providing. And if the if the pricing structure is high, yeah, so meaning that earnings are priced relatively highly. So for each dollar of earnings, the stock price has a certain multiplier. Then, of course, there's a strong incentive to manage earnings, right? Yeah. So, but even if the stock prices are relatively low, so if the multiplier is relatively low, there still is an incentive to manage earnings, because if the stock prices the firm as if the manager manages earnings, then the manager is still better off with managing earnings, technically, right? So now is this then now you would be in the upper right quadrant, and this is then the Nash point, the typical prisoner's dilemma point, where the stock prices the firm as if it manages earnings, and the manager also manages earnings, right? So now the problem with this upper right quadrant is that nobody wins. it's a really bad equilibrium. So the earnings management does not pay off for the manager because he cannot fool the capital market. So the capital market foresees that the manager will manage earnings and prices the firm assuming that the manager does manage earnings. So there is no stock price boost to be made from managing earnings, but there is the direct cost of earnings management. That here maybe I took the liberty to just classify as -1, right? So this is the loss that the manager actually makes from managing earnings here in this setup. So there's no gain, but a little bit of a loss. And in the Stein model, this is actually quite substantial, because they argue that this will be suboptimal decisions by the manager. So the Stein model is often understood as a model describing why managers are sometimes doing stupid, short-sighted investments instead of investing in the longer goal. And the idea is here, they have to do this because they are priced as if they are doing it. And if they are priced as if they are doing it, then it would be even worse for them to engage in long-term investments, because then they would be priced even, then the stock price would be even lower, right? So this is the exact situation that we have here. So is there an easy way out? Not really. Yeah. So you have this dead weight loss here. Earnings management is continuing simply because the market expects managers to do it. Managers would be much better off not doing it, because then the costs of earnings management wouldn't be there anymore, right? So the efficiency loss of earnings management would be gone. Yeah, so there's absolutely no advantage of earnings management in this setting, in this type of models. There are multiple models that have a similar setup than the original Stein model, right? So and these models can be classified as showing that earnings management creates a dead weight loss to society, producing costs but bringing no benefits whatsoever. So of course, this is unfortunate, and in such a setting, everybody would have an incentive actually to engage in or to require rules that make it possible to commit to not managing earnings, right? So this is a clear case which has been used to support discussions of tighter enforcement and better assurance, to make sure that managers actually don't have this stupid incentive to manage earnings anymore, because they know that in the end, if they manage earnings and the market foresees this, there's nothing positive coming out of this anyhow. It's just a loss of resources. So I think this intuition of the Stein model, and as I said, there are a bunch of similar papers that have the same argument. This is really important to understand, right? So you can be trapped in this bad equilibrium due to earnings management. And I think this is also something that most likely is somewhat empirically descriptive. So good to know. Okay, so now we still have the it's complicated a part to fulfill, and that means that earnings management is not always bad. Earnings management can actually be desired even, and to give you an intuition for why, I'm taking a very simple bare bones model here that I think was also once in the Ewart and Wagenhofer textbook. I'm not sure whether it's still in there. And conceptually, it's based very much on the Joe Dembski paper in the Contemporary Accounting Review in 1998, where Joe Dembski talks about the range of different arrangements in which earnings management can actually be beneficiary or helpful in performance measurement. So what we have here is a typical agency model, a relatively simple setup. The unique feature of this model is here that we have two connected periods. Okay, so we have two connected periods. In each period, the manager has to exert effort, and the principal or the investor will incentivize the manager to exert effort. And the trick of these two periods here is that the manager can manipulate earnings in one period, and this will reverse in the next period. So it's a typical accounting setup. So you can lend a little bit from the future period, or you can push a little bit to the future period. So very close also to the Healy compensation example that we discussed. But it will reverse, and it will reverse entirely here because we have a two-stage model. So obviously the manager from working has some disutility here, and it's all for convenience, right? So you can see this utility function will differentiate nicely, and there is a reservation utility to be met here, and this is very important. The manager is risk averse, which is standard in these models, and has a constant absolute risk aversion function of exponential form, like you see it here. So now, so there's a salary. The manager is being offered a salary contract, and we assume the salary contract to be linear in the report or in the true earnings. Yeah. So now with all this structure here, now you could stop the video and start to do the math and try to figure out, well, what would be the ideal contract conditional on whether you can observe xt or xr. And I don't want to, like usual, I won't do the math here, but I want to show you why you get a somewhat, at least at first glance, somewhat surprising result from doing this exercise. So before doing this exercise, you might say, okay, if I can observe the true earnings, that would be good, because then I don't, the whole earnings management B cannot mess up the report. So I can just directly contract on basically a noisy effort measure, and that's xt, right? X sub t, so the true earnings. So that should be efficient. That should get me closer to first best. The surprising finding here is that actually it's better to write a contract on the reported earnings. Not although, but because here the manager can manipulate the earnings. And to show you why that is, I have one last figure for you. So this figure is a standard figure that many of you might have seen in other circumstances. So this shows the exponential utility function of our manager. And to show you why earnings management is a good thing here in this particular setting, we have to think about the insecurity that the manager faces. So to understand this, please focus first on the two greenish/petrolish dots that you see on this curve. So these are two potential realizations of the salary that the manager will get based on a certain effort level that the manager will choose in equilibrium. So we know that although the manager in equilibrium will choose a certain salary level, still the actual effort level, still the actual salary that the manager will get is uncertain, right? So because there is the noise in the returns, right? So it means that it could be that in period 1 we get a salary of 1, and in period 2 we get a salary of 2, right? So these are just two draws from the underlying distribution of a report earnings that this firm will materialize. Now for the manager, because of the curvature of the utility function, that means that the utility that they that she can expect from the compensation ex ante is like indicated here, the expected utility, just the average between these two utilities, U1 and U2. Okay, so this is what the manager can expect from her work for the firm, given a certain salary and expectation, right? So the fact that there is insecurity about the actual outcomes of the salary causes the expected utility to be strictly lower than the utility that the manager would get if, instead of an insecure salary, the manager would get the expected salary directly, right? We understand this. Yeah, this is why this is a utility function that represents risk aversion. Okay, perfect, good. So now let's think for a second that the manager has the opportunity to add or subtract B from both salary points. Here, obviously, this would be a different setup because it looks as if S1 and S2 are known. In the game, they are not known, yeah, but still the same intuition holds. So what the manager can do now, she can manage it. She can manage the salaries to come closer together by managing the reports, right? So in expectation, she can make the she can make the earnings more smooth. Yeah, by choosing a B that offsets a little bit the random noise from the earnings stream. And this allows the manager to shift from the petrolish dots to the yellowish dots here. So, and this again, yeah, leads to less risk for the manager because we now have smoother earnings, right? Less risk means translates to higher utility for the manager, right? So we reach the new expected utility conditional on earnings management being a thing, conditional on B, which are strictly larger than the utility without earnings management. So meaning the utility here is good. So the earnings management utility at first glance is good for the manager because it allows the manager to smooth her salary. Okay, cool. So now, if you take this, you might say, okay, that's good for the manager, but my job is here to think about a contract that the investor will draft. So how can this be good for the investor? Now, if you are good in these type of agency models, you will already know the answer. And for the others, it's not that hard to see that now that the manager is making a higher utility here, out of the same work relationship, the investor can use this higher utility to have tighter incentives on the contract, meaning that the investor can set a salary that is even more aggressive, meaning that it will exceed even more effort in equilibrium. Yeah, so also more disutility of working hard. Yeah, so that until the end, and this is typical for this class of models, the manager again is just being indifferent whether taking the contract or not taking the contract. So meaning that the participation constraint of the manager in expectation will be met. Yeah, so that translates to the expected utility with earnings manager just being equal to the reservation utility of the manager. Yeah, and this means that the investor can reap all the benefits from this income moving from the manager here in this equilibrium. So the investor will in the end benefit because the investor will in the end have more incentives on the compensation contract resulting in higher efforts from the manager. Yeah? And in the end, it's the investor wins. Okay, so this is of course a very bare bones model, but I think it shows something very interesting again. And this is close, also similar to the intuition of the Alfred Wagenhofer and Robert Güchs paper. So again, this is a question of risk sharing here in the end. So it boils down to efficient risk sharing here in this type of economy where we have a risk neutral principal and a risk averse agent. Ideally, the principal would carry all the risk, right? Then we would have first best. And here earnings management now becomes a tool that makes it easier or makes it feasible to have some more advanced risk sharing, right? So the manager can reduce the volatility of the earnings, resulting in less risk for the manager, and the investor can use this slack that is being generated by the manager's moving earnings in order to have tighter incentives on the manager, so that in the end the firm becomes more productive. Okay, interesting, right? So here you see now that earnings management is not always as clear cut, right? So we had 3 different models. So the first model shows us that if you have screwed up incentives, then you cannot be surprised if you observe some earnings management behavior. Yeah. So, and then it becomes a question: how can these screwed incentives actually be, stable in a long-term equilibrium? So, shouldn't they go away? Then you have this Stein type model, which shows us the deadweight loss of earnings management in the market where everybody is rational, so that in the end their earnings management goes on although it doesn't benefit anybody. Yeah, so this is the bad earnings management. And here towards the end we actually have the good earnings management that helps a little bit in risk sharing. Yeah, so it is a mechanism that allows managers in a flexible way to to reduce their risk, and the risk reduction again in terms is good for the investors or the owners in this case. Okay, so this was the last video of the third unit. I'm looking forward to the discussion session next week, and have fun prepping for it, and see you around. Cheers, bye.